Welcome to another riveting episode of Finance Footnotes. Today is June 4th, 2024. My name is Brent Stransky. I'm here with my friend and colleague and co-host, Zach Miner. And today we're going to unpack some of the most exciting variables happening in the marketplace today. Just one step back, I wanted to share why I think it's important for folks at home. I just don't think many of the folks out there adding their opinion out there in YouTube and other places have experience. We're licensed professionals. We've got a significant amount of student debt and degrees behind our names. At least at one time we had student debt. So I think we can add some significant value by taking a different approach through the lens of experience. That being said, let's dive right in. Let's see where we are. Since we spoke just 2 weeks ago, the market has taken a bit of a pause, a hiccup, if you will. So right now we're looking at the three major indexes here. This is from the Wall Street Journal this morning. Tuesday, June 4th. And we can see particularly the Dow Jones there on the left. I have a green arrow showing you that it is below its 65-day moving average, indicating some technical weakness. Some of the other indexes, the S&P 500 and NASDAQ, bounced recently off of that. What does it mean going forward? Well, we'll talk a little bit more about that going forward. But certainly, the Dow Jones doesn't have a lot of the big tech names. We won't mention them by name, but the big tech names you can think of aren't necessarily in that Dow Jones index, and those have certainly been powering the markets higher. Wouldn't you say, Zach?
Yeah, absolutely. And that's the other indicator that's not quite working these days is the Dow theory, where you kind of look at the transports index, within the Dow, and that's been performing terribly, while the rest of the market has continued to power higher.
Yes. What will it mean going forward? Well, we've got an answer for you coming right up here as what it could possibly lead to. But I want to share with you one thing that I don't think is floating to the top of the newsfeed as much as you might expect. But that's it really pertains to all of us folks traveling for the summer here for summer holidays. The gas prices. Price per West Texas crude as of this morning down to $73 a barrel. It was as high as 85 or 87 up 6 weeks ago, which I was kind of surprised to see that, but down, between 15 and 20% since just 2 months. Of course, it's something that's very volatile price. That's why the Fed often backs this out of the inflation numbers, because it's just jumping around so much. But I think this is a good context for one, lower inflation going forward, and two, for your summer driving season. Hopefully you'll see lower prices at the pump. And that, as we know, Zach, we talk about it here on Finance Footnotes, translates to better consumer optimism. Direct correlation.
Yeah, it's been a little while since we've ticked into the 60s on oil, and you tend to see it rise into the summer driving season, but so much of the supply side of oil is controlled by OPEC plus and their ability to really open the spigot or close the spigot kind of as much as they want. And there's inside baseball reasons as to why they do the things that they do, as far as geopolitical things that they're trying to influence, or internal cash flow things. When it comes to Saudi Arabia, they could simply produce more oil, and even though the price may come down, cash flow could go up. So there's a lot of reasons why they kind of do the things that they do. It's not always readily apparent or logical, at least to us, as outside observers. But I'm sure it's logical, to them.
I love the inside baseball reference. And our loyal followers at home will know we've talked about this before. But in fact, OPEC has become less and less influential as America has become the number one energy exporter in the country for 6 years in a row. Incredible. We talked about that a month or two ago. But still, obviously,
I would say, yeah. So I would say that they're still very influential when it comes to kind of the global price of oil. They're much less relevant to our energy needs domestically, right? So that's totally true, that when it comes to what OPEC is doing, it's not necessarily going to change our energy consumption methods or things like that. They definitely do still have an influence over things like the price that we're looking at on the screen right now.
I wasn't trying to offend OPEC. They're still influential.
Don't offend OPEC. They're very.
You never know who's listening.
Yeah.
Yeah. So moving on here, we often cite our friend and former colleague here at LPL. He's now head of research at Carson. He puts out great data. We follow him on Twitter, and he had this great chart here. So what the heck happens? May was up. The primary stock index, the S&P 500 in the U.S. was up almost 5%. Last month, it was a great month. So the folks at Carson did some great research, and they said since 1950, May has been up 4% or more for the S&P 500 a total of 12 times. And well, what the heck happens for the month of June and throughout the rest of the year? So the chart I'm showing, has not one, but two green arrows. Number one, what happens in June there, you can see that 80% of the time it's higher with an average of about 1%. And what about the rest of the year? That's my number one arrow, the green arrow there. For those of you watching at home, you can see that it's higher 70% of the time when May and June, typically slower months. So when you have a really strong month, what does it mean? You could look at an average 12% to 13% over that, the rest of the year. Okay. The next 7 months of the year, higher 70% of the time. Okay. Well, what does it look like on an average year? So they also included that data. So for the 73 years in total, including those months that weren't so gangbusters in May, we can see that markets are up higher, maybe about 72% of the time, right? But the average is much less attractive, 6% average return. So not really sure what to make of this other than stay the course. What do you think, Zach?
Yeah, and even the two of the one, 1986 and 1975, the rest of the year was down, but marginally, 1%, 2%, which means that the annual return was still positive if it was up 5 and 5 in May and 4 and 1 in June.
Would you say that the tone in the market has gotten noticeably more pessimistic in the last 2 weeks? I feel like since we spoke last in the podcast, I'm not sure what's driving. And so I thought this chart was so helpful because, we test step back, look at the data, not always accurate, but I'm not sure what has changed. Maybe the Trump verdict has kind of accelerated the political discourse, but dang, it's gotten pretty ugly out there. But I think this chart gives us the indication, hey, we just got to stay the course. Things typically work out, in the longer run. So that's the only point I wanted to make on this chart.
And a lot of those sentiment indicators have flipped, and we'll put we'll pop this chart in here as well for the fear and greed index, and it's in fear right now, which is interesting. And you had
that is very interesting.
You had neutral, a week ago, and I think greed, just a month or so ago. So we've kind of ticked to the other side of some of those sentiment indicators, which generally.
I'm shocked by this. I'm just pulling up this. You're talking about the CNN Fear and Greed Index. It's been peaking, recently. But wow, 40. Wow. So which from my perspective, as you know, at home, I'm contrarian in this particular indicator. So I'm glad to see that. I think it means that people are taking money off the sidelines and actually can put money to work.
Yep.
Great point, Zach. Just building on that, I was reading in Barron's magazine over the weekend, and I didn't realize this. You probably did because you're a CFA. And what I read was that over the last 2 years, so 2022 and 2023, each of those years had, in terms of people putting money to work in the U.S. stocks, was actually negative for mutual funds and ETFs. So there's actually a net drawdown of people investing. That's flipped. So in 2024, so far, there's been a net addition to these funds. I was really surprised by that. The 2 straight years in a row, there were net subtractions and deductions from funds. Really kind of gives you an idea of how pessimistic things have been for so long.
Just from equity, the equity side of funds, right?
Yeah, equity.
I wonder what the fixed income side looked like. Yeah, I wonder what the fixed income side looked like.
Because you probably saw report back.
Yeah, you probably saw some inflows, I would think, into the fixed income side of things as rates went up, and fixed income was giving you 5+%. But that certainly is interesting. Yeah.
And bonds have had a couple troubling years here. But that being said, so taking a quick step back, we talked a little bit about where the markets are. I wanted to give you some optimism. There's a lot of pessimism at the moment. I think June, could look pretty good. And I think the rest of the year, it stands to reason to stay the course. It looks pretty good. And if it does remain positive, there's more bang for your buck, on average 12% throughout the rest of the year versus 6% in the average year. We just talked about the pessimism in the marketplace. The last point I want to share with you, I think is maybe the most important. Well, actually, I guess before I get to that, sorry, I'm so excited about that last point. One point about leading into pessimism here, people's personal finances. So I have a chart here from the Federal Reserve Bank of New York. It was published in the Wall Street Journal last week, and it's showing you that there's been a growth in the number of delinquencies. Folks that are 90 days or more behind on their credit cards, especially, is getting close to 11%. I'm always shocked by this. The folks you see walking around in the malls, 11% of those folks are 90 days or more behind on their credit cards, which is a pretty seismic shift. Important to watch, because that's probably the first payment you're going to stop paying. You're going to keep paying on your car. The last thing is probably your house. So, those indicators are also here. I think positive. Mortgage is still 0.6% or 90 days more delinquent. That's pretty much looks like a cyclical low. I just wanted to point that out. It's something we're going to keep an eye on here. Surprised to see how high that has jumped. Zach, any thoughts on that?
Yeah, and that's not the only kind of indicator, that we're seeing when it comes to personal household finance, jump back up to some more concerning levels. And I did a pop in here to the United States bankruptcies, as well has increased by 40% during a 12-month period ending March 31st, end of the first quarter. Now, if you kind of look back, it's kind of just getting back to pre-pandemic trends. So it's not necessarily, at crisis levels, but it does appear that the excess cash and excess capital that had flooded the market during the pandemic has run its course. And it took a full 3 years for that to happen. But now you're starting to see, those small businesses that were keep being kept afloat by PPP loans and access to cheap capital. The same thing with personal household finances, being kept afloat by increased, stimulus checks and excess unemployment. You're really starting to see that run out, and we're kind of returning back to those pre-pandemic trends, and that could have an implication certainly for corporate earnings moving forward, because we've talked a few times about the high bar that is being priced into earnings expectations, and we cleared them in the second quarter. We really did, but we're going to have to keep doing that because the growth expectations are in the third and fourth quarter are even higher. And so I think that something to look at, that I think we've pulled forward a good bit of some of that performance and the expectation of this recovery, and you certainly could have a downside print on earnings numbers.
We'll have to see where it goes.
Yeah.
It's so strange. If you look at the previous peak here, which of course during the housing crisis, 15 years ago, my God, unemployment rates were, right now near historic lows. So this is kind of an anomaly here. We'll have to see how it plays out. But I just wanted to point it out. I think it's something that it's kind of like the first canary in the coal mine. So something to be aware of.
Yeah, absolutely. And I think another important thing though is the mortgage rates are still quite low, or very low. So we have not really seen a meaningful tick up in mortgage delinquencies, and I think that is certainly a good sign.
Yeah. So we'll keep an eye on it here for you folks. Keep tuning in to Finance Footnotes for updates, important as they are. Okay, now finally, the last thing I want to share with you, I think, taking a big step back from our conversation, we looked at a little bit of the, minutia here. I want to take a big step back. And I think a primary consideration here is to how can we become better investors in the long run? And I think it's to look at major indicators and just in major talking points and the talking heads out there, and just always be questioning what they're talking about. And so I want to talk a little bit about the yield curve indicator. You've heard about it for probably 2 years now. And I want to talk about the anatomy of how it's fallen from grace. It was the case that it had been a great indicator of recessions going forward, but I just want to put a spotlight on it here with a few charts briefly. First, what does it mean? Essentially, it means that typically in a normal environment, you're getting paid higher interest rates for longer term deposits, right? So hypothetically, if you had a 5-year term, you'd be getting a higher interest rate than if you did a 5-month term. Well, that has been inverted or flipped for over a period of time. And you can see on my next chart here that there's different periods here. The first, as of June, at the very bottom chart there, as of June 30th, 2021, about 3 years ago, that's a normal looking yield curve. You're getting closer to 2% for longer term deposits, and then almost nothing for shorter term. But then over the last 2 years, going back to July 3rd, 2023, and then May 24th, which is when this data came out, this is inverted. You're getting paid more for shorter term. That's the only indicator it means. You can try to digest or discern exactly what that means or why it happens. It just, from time to time, it happens, okay? The next chart I have here, it's showing you going back to the 1960s, you can see that there have been significant yield inversions. That is where my green arrow is pointing. That's showing you when that inversion happened, when short-term rates are paying you higher interest than longer-term rates. And so where we stand now, we've had an inversion for 400 trading days. That's the longest inversion on record without having a recession to follow. So I just wanted to point out this other final chart here just quickly, which I thought was super interesting, just talking about how often the news has talked about the inversion, right? So this is a phenomenon that's been occurring for we just talked about 50 years. But you can see here, and this is from the Wall Street Journal, articles mentioning yield curve, and you can see here that it wasn't really even mentioned until recently in the last 5 years. So it's something that became widely disseminated in the press. Everyone seemed to know about it. And I think it's a great adage that if everyone seems to know something, it's probably not going to happen because everyone's adding that into their own equation. So uh, the question is, there will be a recession at some point. Can we say that it was the result of the inversion? I don't think you can after 400 trading days, Zach. What do you think?
Well, first, I want to talk a little bit about the mechanics of the federal funds market, and I'm going to try to keep it as least
Keep it
wonky as
bullet pointed,
possible.
buddy.
I'll keep bullet
I
pointed
think we
here.
just lost half the people watching the podcast.
But it's important. It's important because, if you're looking at historical comparisons and you're saying, okay, well, the yield curve did this and, prior to 2008 versus post 2008, it's a very different reasoning. And because the Federal Reserve changed from what's called a scarce reserves system to an abundant reserves system after the financial crisis in 2008. And what that essentially all that means is that prior to the financial crisis, those short-term rates that you see are now higher than the long-term rates, the federal funds rate, which is the overnight rate that banks earn lending to each other, used to be market determined. It used to be the Fed had an ability to influence it, but not directly set it. And now the Fed directly sets that overnight rate. It's a different system. And so when you say the Federal Reserve comes in and raising rates, cutting rates, it has a different effect on those maturities. And so that's the first thing, is when you're comparing something in essentially a different system. Now, it doesn't necessarily mean it doesn't work anymore. It just means that you have to take that into account, that the Federal Reserve has much more of an influence on that shorter end of the curve because they can directly influence
That's
it.
why we're paying Zach the big bucks. In this article in the Wall Street Journal, which was lengthy, it was a deep dive. They did not mention scarcity of the financial reserve system changing into the abundance that you just mentioned. So I think that's a couple layers down. That's why you come here to Finance Footnotes. Certainly a good indicator. But I guess the kind of point I'd make is I haven't read about that. I mean, that's obviously a smart thought. I haven't read about that in pretty thoughtful periodicals. The suggestion, the implication certainly was it's happened before, it's going to happen again. And I think we just have to be careful, right? Past is not prologue. And then, if you just look at the prevalence of mentions of a yield curve inversion and recession, oh my God, just in that final chart I showed. So I think there's a lot of work, to your point, a lot of variables at play.
Yeah. And there's decent reason for mentioning it because it has been a pretty good indicator, and I will say the last chart that I put in, and I'm not sure if this was, I think you had the 400 trading days as the 1 year, 10-year. I think the last chart that I put in here was the 2s 10s, and the 2s 10s has had the 2 year, 10-year inversion has had longer periods than the 400 days. And so that last chart that I put in here, but what the point I wanted to make with this is that it's been accurate, but as far as timing, it tells you nothing. It could be 2 years later, 3 years later. And so, 400 days, that's a long time. But if you actually look in the context of those prior inversions, it's actually really not that long, because you had inversion to recession in 1988, 20 months, 1998, 34 months, 2005, 24 months. The 2019 one, I think, is an anomaly because we had the pandemic. It was just such a non-economic thing, right? It was health related that caused the recession. So I don't think you can look at the mechanics of the yield curve as having anything to do with the 2020 recession, right? So you can kind of take that one out. And then if you look across the rest of them, well, it's kind of like 2 or 3 years that it takes for that indicator to make sense. And so if you take that into consideration, we're actually kind of right at that point where
let's go on the record then. Me and you, buddy, we'll bet a lunch, are we going to have a recession in the next 6-12 months? And then we have this conversation 6-12 months later, and I think it's everything you're saying, of course, is very accurate, but I think we have to at some point just take a step back and say, like, is this relevant? Is it indicating a recession? And I think you bring up logical points, and you and I always try to be as agnostic as possible to the fact that we could be wrong. But that's not the sense you get when you hear the talking heads on CNBC or you read the
Absolutely.
Wall Street Journal. They are much more persuasive in their rhetoric. So
But
I'm just
there's an even more important point to this chart though, because
oh,
look at the S&P 500 return from inversion to the peak. This is up 40%, 40%, 28%, average of 32%. So if you were saying, oh, the yield curve is inverted, let me try to time this recession and try to get out of the market, you know, you're missing out on significant double-digit returns, very good years. So it tells you nothing about the timing. Um, when that eventual recession might happen, I think it does tell you something about the economic conditions that are in place. The longer term rates are generally influenced more by economic growth, inflation. The shorter term rates are much more influenced by the Federal Reserve and monetary policy. So I think it does tell you something about kind of the state of the economy. I'm going to say that there will be no recession in the next 6 to 12 months. I don't, that doesn't necessarily mean it won't be a bear market. I do think that the economy is strong enough. I think that the labor market's strong enough that we're not going to be in a recession for the next year.
and
That's just
time will
my,
tell. And
that's just
and
my, that's my, we'll stake the claim there, but
thanks for going on the
um,
record. And we'll have to see what happens. I would
yeah.
agree with you. Open to being wrong, of course. I guess if I can summarize, we touched on a couple of things. We started by sharing, what happens to the market after a strong May. What does it look like in June and for the rest of the year? Right. It seems to me, and we've agreed to this act that, gosh, the dialogue, the discourse in the blogosphere has gotten very negative, much more negative. I don't know why the tone has changed so fast, but it has. And then we just looked at that inversion in the yield curve. So when you hear these indicators, it's just tough to trade ahead of the market. If you traded when there's an inversion and try to time the market, you would have fallen on your face and missed out. And the same is true here as we go forward into June 2024. So perhaps the long course with judicious reallocations along the way is the smart thing to do.
Yeah, and it's an interesting. You kind of look back at those periods. 1998 in particular, you had a lot of, kind of irrational exuberance. That was a very, the kind of the tech boom. 2005 was really the rebound from the tech crash. So you had some really significant, market appreciation there prior to 2008, and you look around. I was just listening to NPR earlier, and they were doing some focus groups surrounding the election. And this is, anecdata. It's like groups of 12 people that they kind of plucked, from across the country. And on every question, they were split, what's Biden versus Trump, all these different things. But the one thing there was a unanimous agreement on was the economy stinks. They said, do you have the sense that the economy is no good? And like everyone raises their hands. And so it's an interesting,
It's so
sense in the
interesting.
market, right? That I think everyday
how can it be
folks are
things?
very negative on the economy.
It's such a great point, Zach. I was thinking about this morning because you made that point 2 weeks ago that, was it the Guardian newspaper you said had a poll
Yeah,
that showed something like 50% of people think, the jobs market is at all time the worst, and it's the
right,
exact,
right, right.
whatever it was. But this morning, the news, of course, is that Mexico has a new president, the first female president, Claudia something.
Shine bomb.
Yeah, there you go. Excellent. Well done, sir. And but it's interesting because in the journal, which we were talking about this, they said that the growth under Lopez Obrador has been like 1% for year over the last 5 years. It's been very subpar. It's been very slow. But the opinion of the Mexican consumer is at all-time highs. So it's the exact opposite of America. Things are
Right.
all-time highs. Consumers are
Very
cranky.
different.
Exact
Yeah.
opposite in Mexico. And it's just there's no rhyme or reason sometimes.
Yeah.
Cool. Well, great talk, everyone. If you have any questions, please let us know. Thanks for joining us here on Finance Footnotes. We'll be back to you again in 2 weeks. Thanks.